With economic growth in the first quarter slowing and a sign of a cooling labor market in the April jobs report, our next guest thinks both of these things put the Fed in prime position to ease rates. For more, we're bringing in Omar Aguilar, CEO and CIO at Schwab Asset Management. Omar, it's good to have you on the show. So the Fed, you think, is in position here possibly to ease. Just walk us through the reasons, Omar, and when do you think they could start cutting? July, September, December? What would be the timetable, you think?
Yes, thank you for having me. And, the last week was so relevant for the Federal Reserve in terms of monetary policy, between their meeting and also the labor report that we got on Friday. Clearly put them back into the driver's seat of having different options on the table. Not too long ago, there was still the discussion about the potential for a rate hike. I think Chair Powell, clearly made it clear that that was not in the agenda anymore, and the next move most likely was going to be a cut. Our estimate based on, what we see the economy is slowing down, as well as the inflation finally getting to the point where the Fed might look as options, put us into 1 or 2 rate cuts for this year, most likely starting, more in the fall, more like in the September, with still slight probability to do it in July. But certainly, I think the data on inflation will have to give plenty of reasons for the Fed to make that move in July. Most likely will be, later in the year.
And Omar, let's talk about what sectors you like. Just by your notes, I know you like cyclical sectors, and I want to show the audience a Wi-Fi Interactive where I have the sector action for the S&P 500 year to date. And among the top entrants here are energy and financials, number 2 and number 4, up 11% and up 9%. What do you like about cyclicals here?
Well, we have been working with our clients here at Schwab on getting this slow rotation out of the, growthy names that we had in last year into more the cyclical early part of the cycle. The whole premise behind, the work that we have done here is related to what we believe has been a rolling recession followed by a rolling recovery in the economy. And what that does is basically portray the behavior of markets more in the early part of the recovery. We're not necessarily yet at the economy level, because this cycle has been kind of strange, because we're still discussing soft landing, we're still discussing economic slowdown, we're still discussing inflation going down, but the market seems to be going towards those areas. And in that early part of the economic cycle, when we're in the recovery, given that rolling, component, we tend to favor areas in cyclicals that have worked well so far, financials, materials, energy, that tend to do well in the early part of the cycle. And so far, has actually worked. It's probably just the last few months where things are starting to look that way.
Omar, I'm interested, this earnings season profit growth coming in better than expected. What do you see for corporate profit growth, Omar, for the rest of the year?
Well, it's kind of interesting. I think we have gone through these, and there's 2 components. One is we continue to see the strength in corporations. We continue to see that component of, corporations staying in places. And it's a little bit, 2 sides of the story. Companies that continue to spend their capital, companies that have strong balance sheets doing very well, companies that rely on pricing pass-through investors are not doing as well. And I think that's a little bit, you can see some of the earnings reporting areas where the pricing power used to be an easy pass to the consumer. Because of this slowdown on consumption, we can see that earnings, being slightly different across those sectors. But overall, for the market, we see strength in the corporates being very strong, in this quarter, continuation into the next quarter. Now, the interesting thing about this is the reaction of the market seems to be focusing more on revenue and less of earnings, strength. So earnings beats have been very good, close to 80% for the market so far, but the beat on earnings, on revenue, hasn't been as strong, and the market seems to be focusing more on those companies that tend to beat revenue as opposed to just earnings.
All right, we're going to take note of that. We have to leave it there. Always appreciate you stopping by, Omar Aguilar.